So first, let's just talk about the simple S&P chart. And if we just look back over the last 2 years, what do we see? We see the original base formed in 2011. We saw the higher low in June of this year, another base over the last 6-8 weeks. We got up through 1448 2 weeks ago. We think that's an encouraging development. We like the fact we held 1450 on some of the profit taking today. We think you at least give 1475 a run, if not 1525, 1550. One of the reasons why we feel constructive about that move is if we look at what some of the breadth data has looked like. Monday, 17 to 1 advancers to decliners. Wednesday.
So for every 17 advancers, there was only one decliner.
Just one decliner. Wednesday.
And that's that spike right up there.
Wednesday, we followed that up with 12 to 1 advancers to decliners. If we look back over the last 70 years, we can't find 2 days in a row that were that strong, that were that accumulative. So we think that sends a pretty powerful breadth message that there is some money coming into this market. There is some push behind stocks right here. So,
in other words, it's a broad-based rally. It's not just that people are buying one sector. They're buying a lot of different sectors.
Well, really, for the first time in a couple months, I think we can say we've seen some evidence that breadth has expanded, that participation has expanded. One of those areas, if we look at materials, a group that really hasn't been a leadership group for maybe 18 months. What's happened over the last, again, 16 months? Base in 2011, base in 2012. Getting through the downward trend line, breaking out earlier this week. Another constructive group, more cyclical, that hasn't been a leader for about 18 months. We think that sends a positive tone about the broader market as well.
And by the way, you know what's fascinating? You're the second person to actually come on the show in 2 days. Yesterday, it was Gina Martin-Adams of Wells Fargo, who looks at materials versus the S&P. Same thing, they're outperforming. So she's looking at the outperformance. You're looking at just the number unto itself. And
this is just the price chart.
Right.
If we looked at the relative performance of materials relative to the S&P,
right,
what it looks like is a big base that's formed over the last 18 months. So again, what we're seeing is the more cyclical components of the market actually start to act a little bit better. If we break materials down a little bit and just look at what they've done in terms of making new highs, this is what really got us encouraged over the last couple days. This is just the percentage of material stocks making new 1-month highs. It surged to its highest level in about 2 years yesterday. So there's some participation behind this. There's some breadth behind this. There's money coming into the sector. We think that creates a pretty positive framework for being an owner here.
That's pretty staggering. So almost, was it, what'd you say, 90?
96% of the material sector made a new 1-month high yesterday. About 80% of it made a new 3-month high. Those are numbers we haven't seen out of this group in almost 2 years.
All right, now here's the thing. If that many have already had that big a move, do they continue?
What we're talking about here is 20-day highs and 3-month highs.
Right.
We think they're a precursor to 52-week highs. So we think this is early in the move. We like the fact they're gaining some relative leadership. I'd say the same thing for industrials right here, finally starting to turn up after 18 months of underperformance.
Hey, you look at a ton of different charts, and I know on weekends you literally will go through several thousand charts to pick the ones for Monday. When you see this kind of data, or when you've seen this kind of data in the past, when you have 96% of the stocks in one sector that are at 1-month highs, typically, what's the follow-through over the next 1 month and 2 months?
Yeah, the follow-through over the next 20 days, which is 1 month, next 65 days, 3 months, tends to be above average market returns. The last time we really saw these thrusts was at that low that we got October, September of 2011, and the low that we got earlier this year, June of 2012, which were all followed by some pretty impressive returns over the next 1 and 3 month period.
So don't fight the momentum, just keep going with what's working, and materials are working. One of the other things, and we couldn't load the retail XRT, the ETF, but we're going to show viewers on the screen. And as we show viewers on the screen, this XRT, the retail ETF, just talk us through the chart. What do you see when you look at it?
What strikes me a little bit about retail right here is how it really hasn't participated over the last number of days in this rally. Going back to yesterday, we finished on the lows in retail when the rest of the market finished on the highs. We've seen relative strength break down here a little bit. So overall, I don't think the retail framework, the discretionary framework, is as constructive as the rest of the market is at this point.
Yeah, as you point out, when I look at that chart and I see 2012 sideways for the past, 3-4 months, I mean, it's getting tired, right?
Rest of the market breaking out, retail not breaking out. losing relative strength, not making new highs like we're seeing in groups like materials or industrials. Not the best framework, in my opinion.
So is it possible that one of the themes for 2013 is going to be a rotation? In other words, what's been working is the consumer.
Yeah.
Right? Retail's been working great. Materials haven't been. All of a sudden now you start to rotate from retail, from the consumer, into the more cyclical sides of the economy, which is kind of what Joe Quillen was saying. Do you agree with that?
Yeah, that's kind of been the message of the market here, that we're seeing some of the groups that have long been out of favor start to reemerge. And I think what's interesting, those names or those sectors that are losing some relative appeal right now tend to be yield-sensitive type groups. We've seen it with utilities, we've seen it with REITs, we've seen it with tobacco names starting to cast on a relative basis. We like cyclicals here starting to turn up.